Welcome back to the Tax Strategy Playbook. I'm your host, David Wiener, and today we're doing a deep dive into one of the most powerful and misunderstood tax tools in real estate: cost segregation and bonus depreciation. If you own investment property and you're still just taking straight line depreciation at 27.5 or 39 years, you're probably leaving a lot of cash flow on the table. In this episode, I'm going to explain what cost segregation is in plain English, how it works with bonus depreciation, what types of properties it makes sense for, the biggest myths I hear all the time, and finally, how to choose a quality cost segregation firm so you don't get stuck with a flimsy study that can't stand up to IRS scrutiny.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Most investors know that depreciation is this slow, boring deduction that gets spread out over decades. You buy a rental, your tax professional plugs in 27.5 years if it's residential or 39 years if it's commercial, and that's it. It helps, but it's not exactly exciting. But here's the reality. You don't have to treat your whole building as one big 27.5 or 39-year chunk. A good cost segregation study can break that building apart into different pieces with shorter depreciation lives, which lets you accelerate a big portion of your depreciation into the early years of ownership. That means more deductions now, better cash flow now, and more flexibility in your tax planning. Think of your property like a giant box full of different items: carpet, cabinetry, lighting, parking lots, landscaping, signage, specialty plumbing and electrical, and then the actual structure: the walls, the roof, the foundation. Regular depreciation treats the whole box as one item. Cost segregation opens the box and labels each item separately for faster write-offs wherever it's allowed. So what exactly is a cost segregation study? A real cost segregation study is an engineering-based analysis of your building. A physical site visit is conducted to take pictures and measurements, and then engineers and construction specialists break the property down into components. Some of those components are legitimately personal property with shorter lives, like 5, 7, maybe 15 years. Some are land improvements. That's your 15-year property. The pure structural shell stays at 27.5 or 39 years. The end result is a detailed report that says, here's how much of your building we can reasonably classify as short-life property. Here's how much is land improvements, and here's what stays in the long-life bucket. Your tax professional then takes that report, plugs it into your tax return to accelerate your depreciation in a way that aligns with the tax code. You're not creating new deductions out of thin air. You're changing the timing of deductions you were going to get eventually anyway. Now, how does bonus depreciation plug into this? Bonus depreciation is a separate rule that lets you take a big first-year deduction on certain assets with a recovery period of 20 years or less. The key connection is this: cost segregation identifies those shorter life assets inside your building, the 5, the 7, the 15-year components, and then bonus depreciation is what allows you to front-load that into year one, depending on the percentage that applies in that year. So the sequence is this: you buy, build, or significantly improve an income-producing property. A cost segregation study reclassifies part of that cost into 5, 7, or 15-year categories. Then bonus depreciation, which is currently at 100% thanks to the One Big Beautiful Bill, lets you take those short-life assets right away, and the rest is still depreciated faster than 27.5 or 39 years. From a practical standpoint, that can turn a property that breaks even on a cash basis into something that shows a big paper loss in early years, which, if you and your tax professional structure things correctly, can offset other income. Let's talk about what kinds of properties you can actually do this on. Cost segregation is available on almost any income-producing property. Give you some examples: residential rentals, single-family rentals, duplexes, small multifamily, larger apartment complexes, or commercial properties, office buildings, retail centers, strip malls, restaurants, mixed-use buildings, industrial and warehouses, hospitality, hotels, motels, resorts, and also many short-term rentals that are held as investments. And then special use assets like self-storage, car washes, auto dealerships, gas stations, mobile home parks, medical offices, manufacturing facilities, and on and on and on. The best candidates, though, typically check a few boxes. There's a meaningful depreciable basis. So any property with a basis of $200,000 and up is where most people really start seeing a strong ROI on a study, though there are exceptions. 2, the property has a lot of non-structural stuff: interior finishes, specialty build-outs, extensive site work, parking, landscaping, those kinds of things. And number 3, it's used in a trade or business or held for the production of income, not as purely personal residence. If you've purchased or built or significantly renovated a property in the last 15 years, it's at least worth looking into a feasibility estimate to see what the potential accelerated depreciation could be. I, as a cost segregation specialist, hear a lot of myths out there about cost segregation. Let me clear some of those up. Number 1, cost segregation is only for huge institutional properties. I hear this a lot. Oh, that's just for big developers and REITs. It's true that the biggest dollar savings are on big projects, but that doesn't mean that smaller investors can't benefit. What really matters is the relationship between the cost of the study and the tax savings. If a study costs you, say, $7,000 and it generates $70,000 in net tax savings, that's a 10-to-1 return, whether the property is 50 units or 500 units. I also hear that cost segregation is a loophole and I don't want to get audited. Cost segregation is not some secret backdoor trick. It's supported by IRS guidance and case law. The IRS literally publishes an audit techniques guide to help their agents review cost segregation studies. The risk to you is not that cost segregation exists. It's using a provider who doesn't follow accepted methods, doesn't document their work properly, or produces overly aggressive classifications without support. CSSI, the company that I work with, the oldest and largest provider of engineering-based cost segregation, has done over 65,000 studies in all 50 states and has never triggered an audit. Myth number 3, my tax professional can just do that for me in Excel. Your tax professional is essential to your overall tax strategy. But a true cost segregation study is engineering driven. Your tax professional does not have the background or skills to do it. It requires detailed knowledge of construction, materials, and cost estimation, and it produces a report that can withstand technical questions. A simple spreadsheet reallocation with no engineering basis is not what the IRS has in mind when they talk about a quality study. Myth number 4, on the other hand, is there's no downsides to doing a cost segregation study. It's always good. Remember, you're accelerating deductions, not creating them. That means, number 1, you may trigger more depreciation recapture on exit, depending on how you sell. 2, you might pull deductions into years where you can't fully use them if your overall planning is not aligned. 3, it needs to be coordinated with your long-term plans. Are you holding, refinancing, or planning a 1031 exchange? That's why cost segregation should be a team decision. You, your cost segregation provider, and your tax professional. Myth number 5 is I bought the property years ago, so I missed my shot. In most situations, you can still do a look-back study and catch up missed depreciation using a change in accounting methods so you don't have to amend or refile other years of tax returns. Now let's talk about picking a cost segregation firm, because this is where a lot of people either get overwhelmed or gravitate to the cheapest option, and that can be a big problem. To evaluate a cost segregation provider, here are the standards that I use. First and foremost, they must have an engineering-based approach. You want a firm that actually uses engineers and construction professionals, not just some software template. So ask a potential cost segregation company who actually performs the studies. Do you have in-house engineers? And do you conduct site visits? A strong firm will emphasize their engineering backbone. Number two is alignment with IRS guidance. Good firms will design their methodology to line up with IRS guidance and established court cases. When you talk to them, ask, how does your methodology align with IRS expectations? And are your classifications and assumptions supported by published guidance and case law? You're looking for a clear, confident, and specific answer, not vague assurances or the deer in the headlights look. Third is the quality of the report. The value is in the deliverable. You want a report that, number one, breaks down assets in detail. Number two, clearly shows the cost basis allocated to each class life. And number three, includes a narrative explaining the methods and assumptions used in doing the cost segregation study. Feel free to ask for a redacted sample report. If it looks generic, or it's light on detail, or something your tax professional couldn't tie easily into your tax return, that's a big red flag. Number four, ask about their experience and specialization. Ask how many studies they've done, over how many years, and in what property types. A firm that's completed thousands of studies across multifamily, retail, industrial, hospitality, and specialty properties is going to have much better internal benchmarks and a better sense of what's defensible. Fifth, ask about audit support and defensibility. You're not just buying a PDF report to file away. You need to know what happens if questions come up. Ask, if my return is examined, what support do you provide? Number two, do you stand behind your work? Number three, have your studies been through IRS review before? And number four, what do you charge for your audit support? Strong providers are going to be comfortable talking about audit support and have processes in place to handle that. Sixth, ask about collaboration with your tax professional. Your cost segregation firm shouldn't live in a silo. They should be willing and able to coordinate with your tax professional or tax advisor. Ask, how do you involve my tax professional in the process? Will you support a tax professional who's unfamiliar with applying your report? And will you help us run different scenarios so that we can decide the best way to use the accelerated depreciation? Remember, this needs to be a team effort and not one person and another person handling other things. We want to all work together. Number seven, ask them about their fee structure and their preliminary analysis. Reputable firms will usually provide a free benefit estimate up front. Essentially, here's what we think you can reclassify. Here's the rough tax savings, and here's our fee. That lets you make a rational decision. Be cautious if, first of all, the fee seems suspiciously low for the amount of work described, or they can't clearly explain how they arrived at their benefit estimate, or every proposal they send out seems to promise the same percentage reclassification regarding a property type. In my world, the gold standard is a firm that combines nationwide reach, strong engineering resources, high-quality documentation, a long track record, and robust audit support. That's the model I compare any other against. So let's tie this all together with a practical filter. When should you consider doing a cost segregation study on your property or properties? You should at least explore cost segregation if you've bought, built, or significantly renovated an income-producing property in the last 15 years. Your depreciable basis is meaningful enough that accelerating 20 to 40% of it would move the needle for you. You're in a tax bracket where those additional deductions truly matter, and you're willing to coordinate with your tax professional to understand how this affects your overall strategy, including a potential recapture and exit plans. On the flip side, if your income is very low, or you know you're going to sell very quickly without a clear plan around taxes, a cost segregation study might not be the right move right now. So to recap, cost segregation and bonus depreciation are tools to change when you get your depreciation, not whether you get it, but when you get it. Done correctly, with a high-quality engineering-based study and a tax professional who understands your bigger picture, they can dramatically improve your after-tax returns and free up capital to grow your portfolio even faster. If this episode got you thinking about your own properties, here are your next 3 steps in your playbook. Number 1, contact me to get a no-cost estimate for your property and to understand how a quality cost segregation study might be of benefit in your specific situation. I'm also happy to answer any questions that you have on cost segregation in your particular situation or bonus depreciation or anything around those items. Number 2, have a conversation with your tax professional about how this strategy would fit into your broader tax and strategy. If you found this helpful, do me a favor. Share this episode with another investor or tax professional who's still treating every building as a simple 27.5-year or 39-year asset. And if you have questions or want me to dig into a specific case study or specific topics, send them in. I may feature your scenario in a future episode. Join me with some very, very expert guests on all aspects of tax strategy on future episodes. Thanks for listening, and I'll see you on the next episode.